It's a new day. Oh, it's a new time. There's a new way. Gonna live my life all in the
Good morning and welcome to Cover Your Assets, financial tactics for the 21st century, all sorts of things to help you move forward in this new now. We've got Todd Rooker, we've got Derek Walgrave, and Craig Nestor, all sorts of expertise, live, local, and at your service, 855-835-8500. Good morning, gentlemen.
Good morning.
Good morning,
Hello,
Kelly.
everyone.
So it's been a very, very busy week in the world relating to real estate, home ownership, and personal finance, has it not?
Well, when you're on a winning streak, right, we just want to keep it rolling and speak about all the things that we have happening for us as a team and for the families that we work with.
Big announcement. The White House has given a directive, if you will, or the Federal Housing Finance Agency gave a directive to some pretty big mortgage players this last week. Talk about what that is and what it means.
Well, foreclosures have been in the news a lot lately. And by, lately, we mean the last week and the last month and really the last 5 to 6 years. In regards to the number of residential mortgages and where we have entire neighborhoods that are vacant and they're still leaving a mark, not only is it leaving a mark on our economy, but also a little bit on our middle class and as us as a culture. And the pressure from the people driving upstream to say we need a little bit of some answers. And we've seen that the central bank and the Federal Reserve officials have really tried a new strategy to lower mortgage rates and help Americans reduce the burden of debt that hangs over them and stifles this economy.
So we know that there have been many plans that have been released by politicians over the last several years in the wake of the infamous bursting of the real estate bubble, the mortgage meltdown, so it's called, and all of those different things. And I think that the widespread public opinion out there, Craig, is that this stuff hasn't done a darn thing.
Okay, so we haven't done a darn thing, and that's where we're at.
Let's take the gloves off. Come on.
So we actually have people, Americans, moving. We have an Occupy movement, and really the message is clear. We don't really trust you, and you're really not working in our best interest, and we want some different answers. We want answers that help us, not just people in the big towers. Seems to be kind of a general message. And here's the response is trying to help those people that are current on their mortgage, but upside down and really can't manage. Those are the people that the government believes can help the economy right now because they have the income to do it. The problem is they can't access those low interest rates because as they lower the interest rates, we didn't have the equity to refinance. And this program addresses that very issue.
So let's hear about it.
Well, there was a cap where if you had a first mortgage and you were upside down on that first mortgage, it was very tough to refinance. This allows a family who is current on their mortgage to refinance with no LTV limit, meaning if you're upside down, it doesn't matter how much, you can still refinance.
Okay, so break it down just a little bit more, Craig, because there are a lot of families out there that really have higher interest rates. They are current, but they could benefit from these lower rates, and there's been a directive issued for people to refinance.
Let me say something. Yeah. Loan to value,
yeah.
LTV. Just make sure we get these acronyms rolling. That means that if the value of your home is less than what your current outstanding first mortgage is, it means how will you refinance that mortgage when the appraisal is done and it doesn't come in high enough. So what this is allowing a person to do is to essentially, from the government standpoint, saying to the bank, we're wanting you to refinance. Don't look at loan to value equation. Refinance the existing outstanding mortgage regardless of the loan to value or the appraisal. So if you're upside down, you can still get it done. That's what it means, right?
These are the loans, exactly right, that were sold to Fannie and Freddie prior to 2009. So this would offer individuals that have income, they're not behind, some stability and some extra cash flow that would immediately go into our economy. And that's what they're trying to do, ease some pressure, get some dollar bills going out there. In addition to that, we have some very interesting federal cases, both at the state Supreme Court in Florida and in North Carolina, where they're still questioning whether or not banks even have the right to foreclose based on having the proper documentation to do that. So we remember robo-signing.
Yeah, jeez.
That's still alive. And
right.
There's some stuff happening right now that really could change the landscape as well. So what we're looking at, is there a way to help people that have been harmed? That's being looked at. But right now we are rolling out a way to help people that are current and just need to save a few $100 a month like the old days and refinance.
Right, and that's something to touch on too, the robo-signing, and just explain to the listeners what was going on, and how our partners and the attorneys that we work with can take a look at this stuff and potentially help a homeowner based on what it was going on.
Yeah, it seems relatively straightforward that the lender would actually have the evidence or the documents or the right of ownership to foreclose and be able to actually prove that. Well, that's where the breakdown occurs. When they took the loans and they sold them in bulk, they transferred it from a loan to a stock. They kind of did away with some of the paperwork that was required. That's actually been real estate law for hundreds of years here. So now when they want to undo that stock and turn it back into a loan, they don't have the proper documentation to prove ownership, and so they create those documents, and that's fraud.
Well, yes, theoretically it is. But on the other hand, if somebody does sign on the dotted line, I mean, it's hard to believe. I've gotten a few mortgages in my life. I'm on my third, piece of property. And I know that nobody forced me after 39,000 pages. I kind of knew what I was getting myself into. So it feels like almost a weird kind of
Do you
loophole.
work for the bank, Kelly?
No, I don't.
We're going to the bank.
Well,
Call the bank.
I think the issue wasn't the commitment by the consumer. It was the bank that wasn't living up to their part. I mean, they had responsibilities to document, to have signed documents, and when they didn't have it, and it came time for them to live up to their side and foreclose on these homeowners that signed on the dotted line, they didn't have the paperwork. So what they did is they just made it up, and they had one signer sign for the names, of these bankers that supposedly signed them years ago,
And they're notaries.
And
They didn't realize that they shouldn't have
Right.
been signing multiple people's
Right.
names and notarizing them
Right.
simultaneously.
Exactly.
They just didn't get that. I
Well,
guess.
here's why it's a big deal. A promissory note is a financial instrument just like a $100 bill is.
right.
A promissory note's a financial instrument just like a $100 bill is. You can't make a copy of a $100 bill and take it into a store and expect the same outcome.
No, that's true.
Right.
And these pesky little rules have kind of been held our country together for the last 200 years. So
Right.
that's why it's a big deal. But in response to, but they missed their payment, well, they're not the only one that's out of bounds here.
Exactly.
And what we do then is we use these arguments to balance the playing field so we can have a common sense conversation. If you've heard of that with a bank, call the show, right? So that way we can have a straight conversation and do what's in the family's and the bank's best interest. Look, if they can modify that loan, let them modify.
Right.
If they can refinance them, let them refinance. And if you can sell that place, let them sell it, right?
Right.
Let us get down to the bottom so we can start to rebuild.
But sadly, you got to use that leverage to be able to get them to work with you sometimes in a sensible manner, and that's part of the issue. The other thing is in Minnesota we've got special provisions under MIR, which makes things very different than some of the cases that you're citing. Because in Minnesota, because of MIR, simply by demonstrating a payment, making it on time, them accepting a payment, that all by itself creates problems, and going back to ask for for documents isn't necessary here in Minnesota in certain cases. So it's very different. But the big issue is that many of the loans that were done didn't demonstrate capacity for the individual borrower to really be able to show that they could sustain and make that payment. And there's enormous violations that were committed in loans that are interest only, pay option arm, negative amortizing, adjustable rate mortgages, and those loans have many problems, and those loans, that information can be used to negotiate a modification that would otherwise not even be remotely possible because of the unwillingness of these banks to work with homeowners.
So we've really talked about two different potential families here. One is a family that's current, but maybe they've got a loan that they got in on a higher interest rate, and perhaps with this new directive that's come out through the U.S. government, they might be able to refinance even if they owe more than the property's worth and it doesn't appraise. And then the other group that you're talking about here is a family that's in trouble and not being able to make those payments, and there may be ways that they can go in there and fight a potential attack on their property via foreclosure because certain procedures weren't followed on the other side. Am I right?
Yeah, and I'm going to ask the same thing that Kelly did, which is that wonderful. This is another fabulous government program that are the banks going to comply with any of it?
So what's happening is Fannie and Freddie, in exchange for some other things, maybe the state's not pursuing them for fraud committed during the origination process, that they're going to have to do a certain percentage of these. So they're going to call this HARP 2.0, where we're going to try to do it again, and it's the same people doing a very similar program, And hopefully this time we get better results.
Well, let's talk more about that here on Cover Your Assets. 855-835-8500. That's 855-835-8500. Todd Rooker, Derek Walgrave, Craig Nestor. They'll be right back.